welcome to another comprehensive wealth management market outlook video. Today, we're going to take you through what we believe is important about the overall investment environment, how it relates to you and the models that you are in, and try to do all of that in about 10 minutes. If we look at our factor wheel graphic, which we love to use in all of our live events, it's a way to kind of sum up what we're seeing in the current marketplace as it relates to data, which is what we base all of our decisions on. We can see that we have a pretty, no, I call it neutral to negative mix of data, what we're calling our yellow light special. Of course, what we know about yellow lights, if any of us are drivers at least, know that yellow lights mean slow down. They mean caution. They mean there's a higher chance of an accident, and so we better be careful. And that's kind of where we are right now with the current data structure and, of course, tariff policy, which is now at 100-year highs for the United States. If we look at our factor wheel, we know the biggest risks are our valuation. Markets, or at least the U.S. markets, are really, really expensive. If we look at interest rate policy, we know interest rates are a lot higher than they were a few years ago. When interest rates are high, that has a tendency to make money more expensive. It makes it harder for new investments to occur, and therefore it puts those valuations into some level of skepticism. But overall, those high valuations have been supported by a fairly strong economy. They've been supported by high earnings for a number of years now. They've been supported by still strong manufacturing data. All of that still exists. We're just starting to see a little bit of change in that space, which is why you're seeing that yellow highlight for the economy. We have still seen fine unemployment data. We've still seen fine import data. We've actually just saw a negative GDP report for the first time in many quarters. But if you take out some of the front running of tariff policy, where a lot of importers were bringing in lots of inventory into the country, which turns into a negative on GDP, that GDP actually would have been positive. So, ideally, or, you can even look at this in a way from an angle that the economy is still maybe even green shaded overall if we, massage those numbers a little bit. But that said, tariff policy from the government has really caused a lot of fear in the marketplace right now. You've seen short-term momentum in the market turn lower as prices go down. And we know that humans have a thing called recency bias. Recency bias being the belief that something that has just happened will keep happening. So if you see a strong sell-off, like you saw in early April, you might be worried about seeing more sell-off. Other investors might start selling their positions, which pushes market valuations down, which are still expensive, by the way. We haven't really seen that much change, even though we've seen a lot of behavioral shifts. If you look at any of the polling data related to investors, they are all saying we are very fearful. We're the most fearful we've been since 2020, but yet our stock allocations are still at all-time highs. The actions are not matching the words right now. So we still have a lot to go before you can say this is an environment where we can be a lot more confident and take investments, at least in our more conservative investment models. Well, then let's move forward to our model menu and let's talk about how that data setup has really impacted all the various models that we utilize for clients here at Comprehensive Wealth Management. We'll go ahead and ignore the money market position. That's just money market. That's a cash position paying about 4.16%, at least as of today, which is May 2nd. So we're going to ignore that because we're not making any changes there. Another area where we're not making a lot of change is our wealth accumulator models. These are our more hands-off approach models, where we are just trying to touch this as little as possible. The actions taken there is just rebalancing. We took an opportunity to sell some assets that have been doing really well during that market decline we saw in April to buy into things like tech stocks. They got really beaten up in that environment. We're still taking action on your behalf in those spaces, but we're doing it in a disciplined way, trying to follow the strategy as it's laid out for clients in that space. On the other end of the spectrum are our risk adjusting model clients. These are our clients who say, you know what, we want to focus on downside protection. Staying wealthy is more important to us than getting wealthier. And so in this space, these models actually became a little bit more conservative during the decline, during the environment where we saw that yellow light really become evident in our data models. What we saw there, what we're doing there is saying, okay, we're seeing higher risk, we're seeing valuation still high, we're seeing some potential for rolling over of economic data, we're seeing negative market momentum, but we're also seeing higher interest rates. And so we're going to invest in assets that are paying those interest rates to have a higher level of income that you can count on. Now, income is never guaranteed. It's just that at this point, we believe with high confidence that we can get a decent level of return without taking as much market risk. And so we took the opportunity with those clients to invest them in those assets. Looking in the middle of the spectrum, these are more of a blended strategy between our more risk off and risk on ends of the spectrum. Our global allocation model, our go anywhere model, as we like to call it, actually took on more aggression within that market decline. It started out coming into decline a little bit more conservatively invested, and by the end of it, it ends up being one of our more aggressive allocations overall. The tactical allocation model, on the other hand, was already fairly aggressive coming into that market decline, and we took the opportunity to rebalance the accounts or the allocation into a few different areas that we have higher confidence in, considering the current situation, looking at tariff policy in the United States, along with declining, or I should say worsening economic data. Not bad economic data, worsening, but worsening also matters. Now let's move forward and talk about tariffs. This is the big elephant in the room. This is the thing everybody wants to talk about. And tariffs are basically a big tax hike. They're a big sales tax on inventory coming into the country. One of the biggest tax hikes in history, if you look at it on a percentage basis. Now, this data is based on what would happen if we had every tariff that was announced back on April 2nd implemented right away. Those of you who've been following the news know that for every country but China, these have all been given a 90-day reprieve. And right now, we're only charging a 10% tariff to every country except China, which is its own unique story. But this is what is threatened to happen if we get to the end of 90 days, which I believe is up on July 8th. July 8th will be a very important date. If they don't have deals in place or they don't have some new stipulation that allows them to extend these exceptions, you could see a reversion back to what we saw in early April with a higher market volatility and people wondering how expensive are my goods going to be that I buy from other areas of the world. Well, if that happens, well, let me back up here. So we're talking about tariff policy. The big risk of that is we're going to see lower GDP and higher costs, higher inflation, basically across the world. But no one knows at this point how severe that's going to be. We don't know, is it going to be a relatively minor hit as suggested by the blue bars with lower GDP hits and lower inflationary pressures, or is it going to be a larger one because everyone decides to duke it out and we raise tariffs on them and they raise tariffs on us and suddenly no one's trading with anybody? Market or economic trading breaks down across the world, supply chains break down across the world, and suddenly everyone's producing goods at much higher costs and to the end consumer. That's not good for economies. That's not good for consumers. And it could be, everyone's worse off, but we don't know how bad that could be. What that depends on really is, what the U.S. government decides to do, but it also depends on what the foreign governments decide to do. I'm not going to go through all or every one of these pieces on this list. I invite you to pause the video here and take a quick look at this if you want to see what other countries might do in response to U.S. tariff policy. But they're probably going to do something if we don't get some kind of deal made by the time the tariff reprieve comes off in early July. Now, I don't want to sound overly doom and gloom because there is the potential of a positive outcome. And there are parts of our society and government who believe that a positive outcome is possible. Even if we get a positive outcome, there's going to be a transition period. Even President Trump himself acknowledges that there's going to be a transition period. And that can going to be, again, some range of market volatility. It can be no better or worse depending on a lot of different variables that nobody knows right now. And this is why I'm emphasizing the yellow light special. There's a lot of unknowns right now, unknowns in the environment of highly uncertain economic data at high valuations. Those of you who have the ability or desire to take on more market risk, there's nothing wrong with that. Let's make sure we have a disciplined rebalancing strategy for you so we can take advantage of market volatility when it happens. For those of you who want to have a more risk-off exposure because you're concerned about these things, we have an answer for you as well. And if you're wondering where you are, please reach out to us and make an appointment with your advisor team to go over where you are and how you're positioned so you understand how your assets will behave in a period of what we expect to be heightened market volatility. Market volatility that's probably going to largely depend on the leaders of both our country and of China, who are both doing their best to position and get in place or get ready for what is sure to be an epic trade deal negotiation. Until next time, this is Morgan Arford from Comprehensive Wealth Management. Have a great day.